Hey, this is Trader Travis, and in this video training, what I'm going to do is teach you about option volatility and how it can make or break your profit potential. Now, before I define option volatility, what I want to do is first, it's one of the 6 components that makes up an option's price. A stock option, when you're looking at a stock option, you're looking at an option chain. Let's pull up one right here. We're looking at one. Let's just pull any out the thin air. This one is $5.20. There's a lot comprised of that $5.26. There's actually 6 things that go into that $5.20. And that's the current market price of the stock, the strike price of the option, the remaining life of the option, volatility, interest rates, and stock dividends. Now, interest rates and stock dividends, they're a minor factor, and they're usually, they're a factor, but they're such a minor factor that they're usually not covered in most training videos. And so we don't really cover the effect that interest rates or stock dividends have on options pricing, because in my experience, it's been so small, it hasn't really made a difference. Now, by now, if you've been following this video training series, the way we have it laid out for you, you're already familiar with this. You've already seen all this. And if you have not, then what I highly encourage you to do, just to make sure, is just go to our website here, learnstockoptionstrading.com. We have a 6-module course. It's a web-based course. It's completely free. You won't find anywhere else online where it's laid out for you step by step and simplified. I know, because I looked for it and I couldn't find it, which is why I created this course. If you do find another course like it, please let me know. I always want to refer people to other courses that may fit their learning style. But anyway, this is a 6-module course. It's step by step. Each module has about 6 or 7 lessons in it. And so if you've gone through it the way it's designed, then you should be already familiar with these 6 factors here. If not, just go there and go through that course. I promise you won't regret it. All right, so now let's move on back to volatility. Let's define volatility in and of itself. Now, volatility is just a measure of how much something has moved around over a given period of time. And so for stocks, it's a measure of how much the stock price has moved up and down, over a set period of time. And for option volatility, it's a measure of how much the option's price has changed over a given period of time. And so one way to look at it is that option volatility is a measure of risk or uncertainty. Because if something is, really erratic, it's unpredictable. You can't really predict it, and it's something you can't predict, it's hard to really make money off of it. Because it's like schizophrenic. You have no idea which way it's going to go. All right. So option volatility is broken down into 2 components. One is called historical volatility. Another one is called implied volatility. Now, historical volatility, that tells you how volatile something has been in the past. Implied volatility is the market's view of how volatile things will be in the future. It's their, best prediction of how volatile they think the options price will be in the future. Now, these 2 components, the historical and implied, they are actually put into that price that we looked at a few seconds ago. And so this $5.20, a small portion of that $5.20 is comprised of the volatility. Now, what I want to do is change this. I already have it actually changed. So you can see actually implied volatility here. You can see it's expressed as a percentage. All right. So this one is 20%. This September 755 strike is a 20.77% implied volatility. If you go to October, it's going to be 32. November is going to be 27. You come out here to December, 24. January 2013, 24. Now, why October is 32%? Well, my conspiracy theory, but no, actually, it's earnings. Earnings is coming up for Google in October. And you can see here it levels back off to 27, 24, around the 20-something%. Now, let's look up another stock, a Nike. And I want to show you the big difference here. So Nike is implied volatility 70-something% here and 34%. Why so high? Nike has earnings here in a couple of days. And so earnings is an unpredictable event. It could make or break the stock. And actually, let's see if we can pull up Nike real quick and look at its previous earnings for you. So if we pull up Nike here on the chart, we can see that. Let me zoom down here to about a 3-month chart, see if you can see it. Over here to the left of the screen, you can see the last earnings date for Nike. Nike gapped down. That's a very unpredictable event, and that sometimes can happen during earnings. We never know if the stock is going to miss earnings, come out with great earnings, and takes off. And so that's priced into the options price. And so in the beginning, I talked about how, volatility can make or break your profit potential. It's because, it pretty much makes the options more expensive. Right now, the implied volatility is 70%. So these options are only worth $1.66. But if volatility was down about 20 or 30, maybe like Google, these options would be significantly cheaper, maybe even 40, 50 cents. The thing is, if you're in a trade and you buy a call option, or excuse me, you buy an option, not a call option, but if you buy an option, volatility increases, great. Then that means you'll make money just purely off of volatility. Stock really doesn't have to move. Now, if you're an option seller, which we don't cover much in these training videos, but sellers will sell something. Let's say they sold this one for $1.60. And what they hope to do is for this option to dwindle down in value because they'll buy it back cheaper, keep the difference, make some money. But if volatility happens to increase after they sell, then they're going to start losing money. And so those are two different ways, volatility can make or break your profit potential. Another way for option buyers, and this is something that happens to me, there are stocks that actually take off in price. Let me think about one. Well, actually, let's pull up the chart of Google. Google's volatility is pretty low here. I can't think of one off the top of my head, but let's say Google has been steady climbing. But let's say Google gapped up in price and really took off. You ever seen those stocks that take off in price? You feel like you're missing out on a boat. You feel like, hey, I'm missing out on all that money. Well, I can almost promise you volatility has spiked on that option because of the fact that the stock has taken off so fast. And so some people will jump in, buy an option thinking they're going to make a lot of money and not realizing they're overpaying. You might pay 4 times worth something is worth. This volatility here is, 70%, almost double what Google's is. So these options, their pricing might be double what they, usually are. And so people, and I've done this before, you jump in, you buy an option, the stock moves upward, and then you lose money. And you're wondering why. You're like, hey, I bought a call option. I thought call options make money when stocks go up in price. But with the amateurs, because that's usually what they are, people who are amateurs or self-educating themselves, they don't know about this. They wonder why they're losing money. And it's because they haven't factored in volatility. And they didn't realize that they overpaid for that option. And now that volatility is going back down to its normal level, well, their option is losing value. And sometimes, if you pay double, for an option, that stock could move considerably and you still won't make money. It's because you really, really overpaid for the option. So that's it for option volatility. Mainly it's just a measure of risk or uncertainty. The more volatile something is, the more, risky it is because it's unpredictable. And so you're going to pay for that risk. And so that's it for this lesson. If you want more lessons and you want to make sure you stay in our educational loop, just go ahead and subscribe to our YouTube channel or click on the link below and that'll add you to our contact list. Thanks a lot. Talk to you soon. Bye.